And welcome back. Hope you guys had a great holiday. I want to give you guys an update from Fannie Mae because they actually just announced their latest housing market forecast actually through 2024. So in today's video, I'm going to share exactly what they're forecasting to happen to our US housing market in 2023 as well as 2024. I'm also going to give you guys my honest opinion because I agree with them for the most part in their update here or their projections here, but there's some things I'm really going to really point out to you guys in which I really do not agree with them regarding their forecast here. Anyways, hope you guys are having an awesome day and thank you so much for joining in today's video. So let's go ahead and dive right in. This is a report that was published on December 19th. It says here, following a significant decline in 2022, housing and mortgage markets are not expected to recover until 2024. I mean, that's really saying a lot. That they're basically saying here that their housing market's going to continue to slow down in 2023 and not recover until 2024. This also is based on a report from the Fannie Mae's Economic and Strategic Research Group, or their ESR group, by the way. This is a report, or their forecast here is published on a monthly basis, and I make a video for you guys each and every month here. So it says here, a recession is predicted in the beginning of the first quarter of 2023. So Fannie Mae is forecasting for a mild recession in the first quarter next year, in 2023. They also note that a plausible scenario is that the Federal Reserve is going to once again start cutting interest rates in mid-2023. To me, this is a really big projection that they're forecasting here, that a likely scenario is that the Fed is going to start cutting rates in mid-2023, which is obviously so much different compared to the past couple of years. So here's a table I pulled from Uncle Fred's website here. And by the way, you can edit graphs and look at different lines here. So here's what I did. I actually looked at the federal funds rate, which is what the Fed changes when they change interest rates here. I compared that to an average 30-year fix. So obviously the Fed decreased rates, or the federal funds rate, to 0% back in March of 2020, back when COVID hit. And at that time, average mortgage rates were around 3.5%. That's the average for a 30-year fix at that time. And because the Federal Reserve decreased rates from 1.75 down to 0% by March of 2020, that caused interest rates or mortgage rates to decrease. So in 2020 all the way until 2021, average rates or average mortgage rates were around 3%. But when the Federal Reserve increased interest rates back in March of 2022, that's when interest rates for mortgages started increasing big time as well. As you can see there, when they increased rates were around 4.5%, and now they're at 6.3%. So this is a really big prediction here, saying that it's a likely or a possible scenario that the Fed may decrease rates in mid-2023. Because they actually do that, that is likely to decrease mortgage rates, which of course could increase home buying demand. And please leave me a comment below with your thoughts regarding this. Do you think the Fed is going to pivot in mid-2023? But at least in the near term, the Fed has plans to increase rates in order to combat inflation, though. The next interest rate decision by the Fed is actually on February 1st of next year, which is about 5 weeks from today. And by the way, the Federal Reserve, or the federal funds rate, right now is about 4.5%, and the street is forecasting by a 99.9% probability that the Fed's going to increase rates by only 25 basis points. In other words, increase rates by 0.25 percentage points to 4.75%. Going back to Fannie Mae's real estate market predictions here, they actually revised upward their total single-family home sale projections for 2022 as well as 2023. This obviously includes brand new single-family houses as well as existing houses as well. And this is due to recent significant pullback in mortgage rates, according to Fannie Mae. So because rates have decreased about 1 percentage point over the past 2 months, they actually revised upward home sales in 2022 as well as 2023. But keep in mind though, this is revising their previous forecast, which was published 1 month ago. However though, they're still projecting for home sales to absolutely tank in 2023, because have a look at this. The projection of home sales declining in 2023 is due largely to expected economic slowdown because of recession in the first quarter of 2023, as well as the fact is that most people who own houses right now, who have loans on those houses, have historically low rates, much lower than current rates right now. And because current homeowners right now have rates well below current rates right now, this is creating a disincentive to move. However, in 2024, though, Fannie Mae expects home sales to rebound by 14.7% compared to 2023, due to the expectation that economic growth will resume and mortgage rates will also stabilize. Now, here's what Doug Duncan, who's Fannie Mae's chief economist, had to say, and actually agree with him regarding this. He says, "We expect housing to continue to slow, even though mortgage rates have come down recently." As it's been important to you guys, even though mortgage rates have come down about 1 percentage point over the last month or two, this is not going to create a buyer's bonanza and increase this euphoria in order to entice people to buy houses. This is because, of course, rates have increased about 3 percentage points compared to 1 year ago. So even though rates have decreased slightly, in the grand scheme of things, because rates have gone up so much over the past couple of years, and also more importantly, really, home prices have absolutely skyrocketed. This is really causing a housing affordability issue in the US. So according to Doug Duncan, he says home purchases remain unaffordable for many due to rapid rise in rates over the last year, and the fact that home prices, though certainly slowing, I would say certainly decreasing is probably the better way to say that, because home prices, or the median sold price in the US, has declined by about 10% since June of this year, based on data from Redfin here. But he does say here that in some places, home prices are declining. But again, on a national level, home prices have declined by about 10% since June of this year. But even though home prices have been declining over the past 6 months, home prices are still very, very high compared to historical levels, because home prices have increased so much over the past couple of years. And Fannie Mae goes on to say the following regarding home sales, or the forecast for home sales here. It says existing home sales continue to decline in October, falling 5.9% to a seasonally adjusted annualized rate of 4.43 million units, and that's down 28.4% compared to 1 year ago. This is based on data from 1 month ago from the National Association of Realtors. Again, in October, falling 5.9% to 4.4 million on an annualized basis for existing home sales. But of course, as I reported to you guys about, a week ago, November, it was actually much worse than that, because home sales, or existing home sales, decreased by 7.7% on a month-over-month basis in November, and also declined by 35.4% compared to November of 2021, which is obviously a lot worse than the 28.4% decrease that we saw in October on a year-over-year basis. Also at 4.43 million in October, home sales tanked even more in November. The seasonally adjusted annualized rate was just over 4 million units. And excluding the onset of COVID here, based on my own analysis that I shared in my previous video here, excluding the onset of COVID back in May of 2020, this is the lowest levels since November of 2010, when at that time there was also just over 4 million home sales on an annualized basis. But going back to Fannie Mae's report here, it says, while we continue to expect existing home sales to trend lower in the coming months, the sharp pullback in mortgage rates over the past month, or a month or two, has led to an upper revision in our sales outlook over the next year. But have a look at this, because even though they're revising upwards their home sale forecast for 2023, it's pretty laughable, because their previous forecast, which was published last month, was calling for 3.9 million home sales in 2023. Now they're calling for 4 million in 2023, which is pretty crazy, because this is a giant decrease compared to the past few years. If we actually have only 4 million home sales in 2023, this is well below the past few years, because at 4 million home sales, this is actually would be 1.3 million less than 2019. because back in 2019, there was just over 5.3 million home sales. And obviously in 2020, as well as 2021, we had a very high level of home sales, over 5.6 million in 2020, and obviously over 6.1 million in 2021. So to say we're only going to have 4 million home sales for the entire year of 2023, this would be well below the past few years. They also say here mortgage rates have fallen approximately 80 basis points since peaking at 7.08% in early November, one of the sharpest declines on record. And this has coincided with a sharp bump in mortgage purchase applications. In other words, the amount of applications that home buyers are applying for mortgages right now. So this is a sharp bump here. So this is also something kind of laughable because look how narrow this graph is here, because any fluctuations here look like really big changes here. So look at this. The recent decline in mortgage rates coincides with a rise in purchase mortgage applications, or a sharp bump up in applications here. So this is the MBA's purchase index, which of course is a measure of people submitting applications in order to buy houses, or in order to buy houses with loans, right? And this axis right here is mortgage rates. So when mortgage rates decrease, this causes an increase of applications though, right? When looking at this graphic though, this looks like a sharp increase though, right? So here's another way to look at this. It's just kind of laughable. Anyways, take a look at this. This is on the MBA's website here. This again is their purchase index compared to the average 30-year fixed rate mortgage. And their purchase index is the MBA's purchase index, the Mortgage Bankers Association. So here's the exact same chart compared to this one right here, looking at January 2022 compared to right now. January 2022 compared to now. So I don't know. When looking at this chart right here, it's very, very narrow. For any fluctuations, it looks like very big fluctuations, though, right? So look at this. This right here is more or less the middle of October until now, which is right here. Middle of October is right here. So the blue shaded bar here, or the blue shaded area, is their purchase index versus the orange line there is the average 30-year fix. So rates went down from 7.8% or 7.08% down to about 6.27%. And that caused applications, or their index for applications for people looking to buy houses, to actually increase. So their index increased from 160.5 to 182.5 by the middle of December. But to me, when looking at this, looking at the middle of October to now, this doesn't look like a sharp increase like their chart right here, looking like a very sharp increase for that same time period here. So when looking at this chart right here, their index increasing from what, 160 or 160.4 as of October 24th, now it's 182.5. That's approximately a 14% increase in the past 2 months. So I'll let you guys be the judge on that. Is a 14% increase in the purchase index over 2 months, is that a sharp bump? Now here's something I do agree with them regarding though, because they talk about the increase in rates and also this lock-in effect of current homeowners right now. It says affordability remains highly stressed. I absolutely agree with that. The share of the median household income needed to purchase a median price home today at current rates remains near the highest levels since before the great financial crisis of 2008. This will continue to limit home purchases, especially for first-time home buyers. Additionally, they talk about current homeowners having rates well below current rates right now, and this is creating this lock-in effect to limit home sales in the foreseeable future here, because of course there's this disincentive to move if you have a rate of 2.6% or 3% when rates right now are about 6.3%. So that's creating this lock-in effect amongst current homeowners right now. So combining that with their expectation for a slowdown in economic growth here, they're forecasting for continued declines in existing home sales in 2023. Fannie Mae also had some really interesting things to say regarding brand new home sales in the US here. And actually, this is something I kind of learned actually when reading this. It says, we believe some of the stronger than expected pace of new home sales is due to a distortion in the data caused by an abnormally high cancellation rate in recent months. This is actually something I do know because the average cancellation rate, according to John Burns Real Estate Consulting, is around 26% as of October. So approximately, 1 in every 4 home sales for brand new houses, the home buyer is canceling the contract here. We all know that, right? So when the Census Bureau reports a brand new home sale, this is actually is likely overstated because it doesn't account for cancellation rates that are occurring right now. Now, here's something I found to be very interesting. It says homes with canceled contracts, in other words, brand new homes with canceled contracts, are not taken out of the sales number by the Census Bureau. So when a home buyer backs out of buying a house, that number is not adjusted by the Census Bureau. And according to Fannie Mae, the same home may be recorded as sold multiple times. If you guys follow the channel, you guys all know that the Census Bureau records a brand new home sale when the home builder accepts an offer from a home buyer or a deposit is taken. So a new home sale really acts like a pending home sale. So let's kind of imagine a scenario where a home builder accepts an offer from a home buyer, then the home buyer backs out. Then the home builder finds a new home buyer, gets an offer accepted on that same house. Then that home buyer cancels the contract again. And then again, home builder also finds a new home buyer and gets in contract on that same house. So the Census Bureau record that as 3 home sales for the exact same home. And they do this because the Census Bureau does not actually record cancellations by home buyers. Therefore, because of all this, brand new home sales is likely to be overstated due to the high cancellation rates we're seeing right now. Fannie Mae also provided their housing market forecast through 2024 regarding housing starts, brand new home sales, existing home sales, as well as home prices and mortgage rates. And here's a snapshot showing their forecast through 2024. So let's first talk about housing starts in the US. So look at this. For 2021, there was a 16% increase in total housing starts. That also includes single family plus multifamily. For single family, that increased by 13.8%, and for multifamily, that increased by 21.8% in 2022, or 2021, I should say. But look at this. For single family in 2022, their forecast is for a 10.8% decrease, whereas for multifamily, a 15.2% increase. So builders really pivoted, moving away from building single-family houses, or at least starting the construction of single-family houses versus multifamily in 2022. And look at 2023, down 23.5% for housing starts for single family, whereas in 2021, a 12.1% increase. Multifamily is entirely different because in 2023, a 31% decrease, whereas in 2024, compared to 2023, a 14% decrease. So Fannie Mae is predicting that housing starts for single-family houses is actually going to pivot and increase in 2024. But having said that, here's something I actually just noticed, because 862,000 single-family housing starts in 2024, which is their forecast here. This is well below 2020 as well as 2022, when there was actually over 1 million. Let's also talk about home sales in the US, or the forecast for home sales. So brand new home sales, 2022 decreased by 15.7%, whereas existing home sales decreasing by 17.1% for this year. 2023, another 13% decrease for new single-family houses. And look at this. Existing home sales did decrease by 21% in 2023 compared to 2022. Look at 2024. They're calling for a pivot, though, an 8.9% increase for brand new houses, whereas a 15.6% increase in the resale market. Now, here's what they're forecasting for home prices in the US. This is based on their HPI, or Fannie Mae's home price index. Because in 2021, their HPI increased by 18.9%. They're calling for their index here to increase by 9% in 2022. But look at the negative marks in 2023 as well as 2024. they're calling for home prices to decrease in 2023 as well as 2024. So in 2023, decreasing by 1.5% compared to 2022, and 2024 to decrease by 1.4% on a year-over-year basis. They're not calling for huge decreases in home prices, but still so much different compared to the gains we saw back in 2022, whereas in Q1 and Q2, over 19% on a year-over-year basis. They also provide their forecast for mortgage rates in 2023 as well as 2024. The average rate in 2021 as well as 2020 was around 3%. The average for this year is going to be 5.3%. But look at this, 2023, they're calling for the average rate to be 6.3% in 2023, but then decrease to 5.6% in 2024. And I'm guessing because they're calling for mortgage rates to decrease from 6.3% to 5.6% in 2024, this is probably why they're calling for home sales to increase for brand new houses as well as existing home sales as well. And when looking at this as well, they're actually calling for rates to peak in Q4 of this year at 6.7%, but a decrease thereafter because they're calling for that to decrease in the fourth quarter of 2023 to 6%, and then decrease to 5.4% in the Q4 of 2024. Here's something else I found to be very interesting as well. They actually looked at total mortgage originations, which of course includes purchases plus refis. Look at 2021. The share of refis was 58%. 2022, 29%. But look at their forecast for 2023 as well as 2024. The share of refis in 2023 to only be 22%. And also in 2024, the share of refis only at 27%. So please comment below with your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. And of course, I appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.